Hello, everybody, and welcome to Masters of Real Estate. My name is Mathew Owens, and today I'm going to talk to you all about financial projections and financial modeling and how that can affect your investment in a multitude of different ways, and to make sure you protect yourself when it comes to reviewing financial models, reviewing financial projections, whenever you're determining if you should invest in a deal or not. And so today, let's talk a little bit about that. Let's get into the nitty-gritty about the financial models and projections. The first thing to know is that they are always wrong. There's literally zero exceptions. There are too many things that happen in between a initial financial model and a long-term projection on a real estate project, or even a short-term projection, that are unknowns, things that come up, and different problems that exist in real estate, right? You could have a major repair that's unexpected, tenants move out that's unexpected, a city issue, another, there's a million things that could happen to a property that you can, not understand and not be aware of, or not build into your projection. Now, you can get really close. You can try to, detail out potential pitfalls, be conservative in a lot of different ways, so that if those types of things happen, you have a backup plan and you've built that in, so that way you're just being extremely conservative, so that way you can cover those specific major items. Can't cover every risk, but you can mitigate the risk massively through the right financial modeling and financial projections on any particular deal, right? Whether you're investing in multifamily and analyzing that, or you're investing in single family or promissory notes, or any fund structure or syndication that you're investing in. Understanding the financial model and the financial projections is key to being able to make the right investment decisions. And I don't think enough investors look at this in depth and try to understand those items, so that they can make a determination of, do they agree, and is that investment right for them based on the information they're hearing from the operator, or determining if you should move forward with your own project or not as well. Because financial projections and modeling doesn't just come from you investing with other people. If you're doing a fix and flip project, you're doing a buy and hold project yourself, you want to know, what is this thing going to produce in real long-term cash flow? That's the most important thing. Or if you're doing a flip, what is this thing going to produce on the profits on the sale of that asset? And are you being conservative on those numbers, right? So let's talk a little bit about some of the key metrics that I review whenever I'm investing in an outside syndication. And we'll kind of extrapolate that to the single family fix and flip and buy and hold strategies as well, so you understand some of the differences and the intricacies of those differences. So, some of the biggest investors on the planet are experts at the financial modeling. They know their numbers. They've been in the space long enough to be able to know what variations exist on a per property basis, or what problems could occur on the overall market when they're investing, right? In specific outside markets, there are a lot of differences between, like, investing in a California versus investing in the Midwest, or investing in Florida, or other markets that might have different weather patterns, have different insurance, different property taxes. There's so much that goes into this. Understanding that is absolutely the most important thing you can do when you're reviewing an investment, if it's viable for you based on the numbers. Okay, so yes, you still have to do your homework on the operator as well, the market in itself, but the numbers and the financial projections and the estimates of those operators is extremely key to being successful. And so let's talk about some of those numbers, some of the things that can be different, right? So some of those metrics are, for example, rental increases and expense increases. So many investors go through and put an average affordable inflation rate involved in those rental figures, as well as an inflation rate in those expense figures too, so that they can determine, okay, what is this thing really going to produce over the long run, right? If you're buying in year one, you have year one set of income and expense items, and you want to know if you agree with those first. And then you want to say, well, what is the assumption that's going to happen with rents and expenses and the long term? And so one of those biggest assumptions is the rental increase and expense increase. Some operators and most will apply them equally and say, hey, rents and expenses will inflate at the same rate. In a lot of cases, that may not be the case, right? What if rents go down while we still see inflation on expenses? That could occur, of course, it could. You have to have wages grow for rents to be able to grow as well. And there's also supply and demand on affordability of housing that takes effect. People that can't afford to buy a house might go rent a house as well. So there's different aspects of the economy to pay attention to when you are looking at that specific metric. If you see somebody start to say, hey, rents are going to go up by X amount, it might be higher than expenses, that could be the case. Or they could be pushing the numbers so that way it looks better. But in my eyes, that's not necessarily conservative to be able to do that unless you have a really justified base for doing that, where, you see massive amounts of population, rents are going up 20% a year or something, and, you're going to make that a little higher than what expenses are. On the other hand, we've all seen what's happened with inflation. Is that going to continue as well when you are investing in different ways? Are you going to see repairs go up? Are you going to see insurance go up and property taxes go up over time and labor go up on property management as well? So if you are going to see that, maybe inflation could be at the 15% range, and now you are at an inverse of rents possibly, breaking even if wages don't go up, or even going down in value while expenses go up at the same time. So you could get squeezed on that side. Of course, what we've seen in the past is typically rents going up and expenses going up at an even pace, or that's what is, I'll say, recognized in the industry as reasonable to assume. At the same time, it's really hard to predict all this stuff. We don't know how things are going to go. So you have to know, based on your comfort level, where you think the market's going, which direction these things are going to head for the long term. Short term is one thing, long term 10-year projections is a completely different thing, right? So just that one metric, you really want to be able to understand what's going on in the economy. Do you agree with the operator's assessment of that? Or if your own deal, what numbers do you think should go in there to see the viability of this investment long term, right? Now, one of the other things is vacancy factor and bad debts factor, right? If the economy is going down, is that bad debts factor going to go up, or is it going to go down? Are you going to come in as an operator and make it more efficient and have better quality control in your tenants? And so therefore you have less of a delinquency factor and less of a vacancy factor because operations is in tune with the entire property, right? You have proper procedures in place on the management side. And so vetting the property manager in that deal when you're analyzing the vacancy rate is going to be key to determine how fast are they filling their units? What's their average time on the market to fill these units when they go vacant? What do they see as far as turnover rate and things like that? Diving deeper. And so you can see where each one of these metrics within the financial projections needs to be looked at and understood from an operator's perspective. Can they make this work based on what they're doing and they're performing, or can that management team make these numbers work based on their experience, right? So you're looking at these not just in relation to the deal, but the operator's experience and what they've been able to accomplish in the past as well, right? So another big ticket item is property taxes, right? You might have one set of property taxes when you purchase that building, but then 2-3 years later, maybe that gets reassessed at that time. So understanding when properties get reassessed for property taxes on the deal you're looking at, and did the operator build that into the financial projections so you can understand, hey, does that make sense? Is that going to actually get reassessed? And did the operator think about it and put it actually in there? That shows you, does the operator know what they're doing when they're providing you financial projections, right? To actually increase those property taxes. Same thing goes with insurance. You might be looking at historical 12 financials, but that insurance piece is going to be massively different from the seller's basis and what their insurance is covering. You never know what quality insurance that other seller has on their building or what basis they have for that insurance in place. and how long ago they got it. Insurance rates have gone up, massively over the last few years, of course. So what is your policy going to look like? And you should be getting quotes or asking, did you get quotes on this building from your insurance as well? Obviously that's usually verified by the lender as well. So usually that's in line with what an operator is going to bring to you, but you won't want to just underestimate insurance based on the trailing 12 financials, when you're looking at a deal, right? So these things are key. And then you also, on top of that, have CapEx, right? And preventative maintenance that needs to occur. And so when you're investing in a building, let's just talk about a single family home actually to start, so you understand that and we can multiply it by the number of units. You have a roof. You have plumbing, you have electrical, you have HVAC systems in place, you have appliances, you have, preventative maintenance on the exterior of the home. There's a lot of pieces of these that degrade over time or have to be replaced at some point in the future. So if you have a 25-year roof, you should be taking the inflated value of that roof in 25 years and writing it off over a period of time and saying, okay, how much is that roof going to cost each year? How much, if I have to put money aside for it, how much is it going to cost each year? And then how much is it actually going to cost me on a monthly basis? Let me put that in my CapEx calc. What about plumbing, electrical, HVAC, appliances, all those major big expenses? You should be allocating and saying, hey, the HVAC system should last 15 years. Okay, great. Let me go take the cost of that divided by 15 years, divided by 12 months. That's how much I should be putting aside for my HVAC system. A lot of mom and pops that run their business don't account for these things correctly. And what ends up happening is they're getting great cash flow for years, more than they thought they were going to get, and they're killing it, right? And then all of a sudden, a bunch of stuff breaks, and then they're in a bad spot because they're going, oh my God, this building doesn't cash flow. Let me go sell it. I can't deal with this anymore. And it's just because the CapEx wasn't put aside for these items on a consistent monthly basis, taken out of cash flow and put aside for those major big ticket items, right? Or they weren't assessed up front. A lot of people will put a lower level CapEx to come out of that, but they forget, hey, we're going to have, this many HVAC systems in a multifamily, or this many roofs, or this many pieces of major systems that are going to need to be replaced in the first 5 years of that investment. And maybe that operator doesn't put enough aside for those specific big ticket items. So these are all things you should be considering when you're analyzing financial projections in different ways. And then also, one of the biggest ticket items that I'm looking at is, what is the all-in cost on the investment, right? The purchase price, the renovation, the reserves, any fees or lending costs, or, other asset management costs involved. What is the total cost versus what is the after repaired market value of that asset? Think of it like a flip. What's your cost versus what can you sell it for, right? You want to be looking at that on a multifamily or on a mobile home park or any other investment that you are looking at for your downside equity protection on that particular deal. And so when you're analyzing these properties, you're saying, what's my all-in cost based on if the manager is going to actually increase the value of that property through renovation, increasing rents, operating efficiencies in different ways. If they're going to increase the value of that, maybe by the end of year 3, for example, and they have a value phase that they're coming in, what is that value versus what your all-in costs are, and what's your cost to value? That gives you your equity protection to be able to understand what actually your risks are in the overall market. If you think the market could potentially drop in value, then how much room do you have for that to drop in the first place before you start taking a haircut on your investment, right? What do you think is going to happen in, the future as well, right? As far as rental values, right? Where's your cash flow going versus your loan amounts? What are the different interest rates that, risks that you're seeing? A lot of what we saw in the past few years is interest rates going through the roof, a lot of multifamily operators ending up in a lot of distress. And so being able to make sure that you analyze your interest rate risk effectively is very, very key. And that's a major financial analysis part of the financial projection is, how long is your loan for? Are you doing a short-term loan that's 3 to 4 years long? What's the interest rate going to be in 3 to 4 years? You better buffer that number from where it is right now to be safe, and hope it goes down, of course, to you where you can actually, get an advantage of that in the future if that occurs. But there's always a risk of that interest rate going up, right? How long is that loan term? All these things are major factors in your decision-making ability, and you need to understand it when you're analyzing a deal to invest in. Do you agree with those assumptions? Is the operator being efficient and conservative on their numbers? And how can you determine, are they going to be a good operator and make this decision going forward correctly and make the right decisions to increase the operating efficiencies of this deal? Are they going to be right on their financial projections in the first place? And where do you think those numbers are going to be? And what does your downside risk look like in that particular deal when you're analyzing these different projections that you're being, shown on any prospective investment? So I hope this helps you guys get a little more detail and understand what things you should be looking at when you're investing in any outside operation. You also want to understand, renovations. It's really good if you are an operator yourself and start to do some of this work, because you start to firsthand see those risks. So I hope this helped you guys, understand a little more about how to analyze syndication deals or other types of deals you plan on investing in when you are looking at the financial projections. If you have any questions, reach out to me at MathewOwens.com, MathewOwens.com. Thank you so much and have a great rest of the day. Do you want to learn how to create financial freedom in your life through real estate and take your investing business to the next level? If so, you can follow us in one of the following ways. First, you can take one of our free webinars on how to analyze property, how to raise capital for real estate, and how to market and find deals. 3 of the key pillars to becoming a successful real estate investor. Number 2, you can join us on our mailing list where you'll get tips and tricks on real estate investing directly to your inbox. And number 3, you can take our 6-month real estate course that teaches you every aspect of real estate investing you can think of, and more importantly, create financial freedom in your life through real estate investing strategies that I teach. If you want a master's in real estate in 6 months, this course is for you. We're going to go over how to raise money, promissory notes, syndications, fixing and flipping, buy and hold investing, tax and legal structures, self-directed retirement accounts, financial education, how to run a business, how to market and find your deals, and most importantly, how to create that financial freedom in your life so that you can stop trading your time for money and create passive real estate cash flow that you can live off of. If you're interested, go ahead and click on one of the links below, and I look forward to seeing you guys on the other side.